8 days. That's all it takes for a house in Irondequoit to vanish from the market, while Manhattan's towers quietly price a comeback after 5 straight months of gains. Here's the split screen of New York real estate in sharp focus. Across the country, homes are selling at a historically slow pace, especially in the Sun Belt, even as mortgage rates fall. But New York is an outlier, and the reasons are stamped into the numbers. In the January through October 2027 period, Irondequoit averaged just 8.49 days on market. That's a blink and you missed it cycle. Its sale-to-list ratio hit 119.9%, and 86.1% of homes closed above the asking price. With months of supply, the tightness gauge where lower signals scarcer inventory, at 0.64 months, the market is operating on fumes. Nearly 4 out of 5 listings, 79.9%, were off the market in 2 weeks. Run 10 minutes west, and the competition doesn't cool. In Rochester, the days on market average was 10.51, the sale-to-list ratio reached 115.9%, and months of supply sat at 1.27 months. Here, 75.6% of homes sold above list, and 67.8% were gone within 2 weeks. When 3 out of 4 homes clear at a premium, it's not just busy, it's bidding war country. The intensity spills into the Buffalo suburbs. Tonawanda Town logged 11.27 days on market, a 109.4% sale-to-list ratio, and 0.82 months of supply, with 76.2% of closings above list and 67.6% off the market in 2 weeks. Cheektowaga ticked in at 11.1, 2 days, a 108.0% sale-to-list ratio, and 1.09 months of supply, 70 to 7.0% above list and 60 to 7.1% snapped up within 2 weeks. North Tonawanda sat at 11.83 days, a 108.5% sale-to-list ratio, and just 0.97 months of supply, 70 to 5.9% gone in 2 weeks. In Brighton, outside Rochester, 11.09 days, a 111.2% sale-to-list ratio, and 1.69 months of supply, still translated to 64.8% above list and 65.4% moving in 2 weeks. Even markets with more breathing room are still tilted towards sellers. West Seneca worked at 12.9, 9 days on market with a 107.9% sale-to-list ratio and 1.11 months of supply, 62.18% above list, and 62.18% off market inside 2 weeks. Buffalo proper, larger and more varied, posted $17.07 days on market, a 104.6% sale-to-list ratio, and 2.41 months of supply. But more than half the sales, 62.5%, still closed above list, and 49.2% disappeared within 2 weeks. A 2.5-month supply doesn't translate to much relief when buyers still bid properties over ask. Downstate, the dynamics are subtler, but the math still shows heat. White Plains averaged 21.16 days on market with a 105.5% sale-to-list ratio and 1.33 months of supply. Fully, 72.2% of homes cleared above list, a higher share than some of the hottest western New York towns, but only 26.7% went off-market in 2 weeks, a sign of more measured pacing. New Rochelle posted 23.89 days, a 104.8% sale-to-list ratio, and 1.67 months of supply, with 61.1% above list and 22.6% gone in 2 weeks. Suffolk County towns held their own. Holbrook at 20.42 days, 103.7% sale-to-list, 1.77 months of supply, with 77.3% above list and 16.8% gone within 2 weeks. Comac at 23.52 days, 102.8% sale to list, 1.56 months, with 66.7% above list and 12.6% moving in a fortnight. Up the Hudson and across the capital region, Schenectady logged 18.46 days, a 102.6% sale-to-list ratio, and 1.76 months of supply, 50 to 5.1% above list, and 49.2% off-market inside 2 weeks. Albany clocked 18.44 days, a 101% sale-to-list ratio, and 1.69 months of supply, 50.6% above list, and 53.1% gone within 2 weeks. Syracuse carried 25.75 days, a 103.7% sale-to-list ratio, and 1.99 months of supply, 58.8% above list, and a striking 62.4% disappearing in 2 weeks, a reminder that days on market and speed to offer can diverge. On Long Island, Centereach's 25.94 days on market paired with a 103.7% sale-to-list ratio and 2.09 months of supply, 74.0% above list but only 10.3% gone in 2 weeks. Smithtown came in at 23.84 days, 102.7% sale-to-list, 1.92 months, with 63.7% above list and 17.7% moving fast. Deer Park saw 21.36 days, 102.4% sale to list, and 1.59 months of supply, 69.8% above list, while just 14.1% were gone in 2 weeks. West Babylon trailed with 29.19 days, a 103.0% sale to list ratio, and 2.04 months of supply. Still, 69.8% above list and 8.8% moving inside 2 weeks. In a state where even a near month-long listing often sells above ask, the pricing power runs deeper than speed alone. The data window matters. All of these numbers are averages for January through October of 2025. Over those 10 months, markets from Irondequoit to White Plains consistently rewarded sellers who priced ambitiously and punished buyers who hesitated. A sale-to-list ratio above 100% means multiple offers are not a weekend surprise. They're the base case. What happened? Scarcity got organized. When Irondequoit's supply compresses to 0.64 months and Tonawanda Town sinks to 0.82, any new listing is like oxygen in a closed room. Buyers sprint. Sellers set the tone. Rochester's 1.27 months of supply and 75.6% of homes selling above list echoes that tension. Even in places with higher supply, like Buffalo's 2.41 months or West Babylon's 2.04, the share of above-list sales, 60 to 2.5% and 60 to 9.8%, signals that demand repeatedly outgunned inventory. Why now? Signals point to a wider rebalancing in New York's economy and property markets. On the commercial side, prices climbed for the 5th consecutive month in the fall of 2025, not just in trophy towers but across large investment-grade portfolios and smaller assets. Year over year, sales volume posted double-digit gains, suggesting liquidity returning to channels that had dried up. Institutional investors who had stepped aside during peak uncertainty re-emerged, fueling stronger performance in upper-tier assets. In New York City specifically, investment-grade properties logged steady gains, with reinvigorated activity in Manhattan and Brooklyn. Several mid-sized and large-scale deals crossed the finish line, a sign of capital's renewed risk appetite. Under the hood, the leasing story matters. Class A office towers with modern amenities drew stronger activity. Industrial and last-mile logistics, the belts and gears of e-commerce, remained firm. And multifamily saw improving demand, supported by ongoing housing shortages and rising rental absorption. Each of those threads tugs at the same knot: scarcity. When spaces in demand remain limited, whether a 2-bedroom colonial in Irondequoit or a distribution node in Brooklyn, price and velocity accelerate. But a market is more than data points and capital flows, it's people. And in New York's residential landscape, one constituency now wags the dog. New Yorkers keep roughly 1.1 million pets. In a 2025 survey, more than half said they spend more on their dog's health and grooming than their own. Dog ownership surged more than 40% in 2020, measured by public licensing data. That spike didn't just fill parks, it rewired demand for where and how people live. Meet Princess, a 12-year-old poodle mix whose preferences set off a chain reaction. Her owners, 2 medical professionals, initially moved from Connecticut into a lease takeover in Long Island City's Jackson Park area above the Queensboro Plaza Transit Hub. The energy was non-stop. Trucks, buses, the 7 train, loud and constant. Princess, used to quiet suburbs and soft grass, was overwhelmed. Within weeks, her stress was undeniable. The solution? A second move, this time to a 2-bedroom penthouse in Long Island City's Malt Drive development. 25 floors up, waterfront, quiet, grass nearby. Even with an ACL tear and a puppy stroller, Princess found peace in elevation and space. Her needs weren't a footnote, they were the headline of the search. Developers noticed. One Williamsburg Wharf in Brooklyn hosted a Santa Paws celebration, complete with a photo booth and paw print ornament station. One Wall Street's Cane Club in the financial district layered in puppy reiki and social events with hand-painted pet portraits. Waterline Square on the Upper West Side commissioned a private pup club designed by a renowned dog trainer. New luxury comes with agility equipment, overnight boarding, and blueberry puppy facials, if you can believe it. Features that move units in a city where animals are family. But this isn't strictly a luxury story. The Heartbeat in Stuyvesant Heights, where 30% of apartments are rent-stabilized, built a green-tiled dog bath. It wasn't decorative. It changed routines. Residents like the owner of Peaches, a 6.5-year-old Korean village dog, shifted from battling a cramped shower to using a space designed for the task. The amenity meant more frequent, less stressful baths and a different kind of neighborly connection. People learned Peaches' name. That's life, not granite countertops. Some buyers chase basics that feel anything but basic to their dogs. Ripley, an 11-year-old Beagle Bulldog mix, splits time between Albany and a sleek condo at 547 West 47th Street in Hell's Kitchen. The 8th-floor dog run was the deciding factor. Visits happened throughout the day. What looks like a sliver of turf from the street feels like a bridge between 2 different lives, easing a country dog into the city. Uptown, a couple traded Brooklyn for 96+ Broadway on the Upper West Side. The building's self-serve pet spa was essential for Bowie, their 4.5-year-old Australian Shepherd. Access to Central Park and Riverside Park sealed the deal. Rooftop sunshine with Hudson River views was a bonus few humans would turn down. Pull those human moments back into the numbers and the pattern sharpens. Builders and landlords are underwriting for a pet-first resident profile, because in New York, it's not a niche. It's 9 digits and climbing. When more than half of residents spend more on dog care than self-care, grooming stations, and private puppy clubs, become as rational as a gym or a doorman. That amenity stack isn't fluff, it's a leasing strategy aligned with demand. Meanwhile, the commercial skyline is quietly moving. Heading into 2026, New York's commercial market shows momentum. Vacancies are tightening. Sublease space is shrinking. Rents are inching up. Return to office levels are outperforming every other major U.S. USE. City, a culture shift that resets base occupancy and foot traffic. Big names renewed or expanded. Bloomberg, Jane Street, Guggenheim, Amazon. The list matters less than the timing. When anchor tenants commit, lenders do the math differently. Trophy towers rose. Billion-dollar sales got done. Hotels performed strongly. Office-to-residential conversions accelerated, turning obsolete floor plates into bedrooms at a moment when those 1.1 million pets and their owners need places to live. But pan too fast, and the picture blurs. This recovery is uneven and fragile. Manhattan is spotted with stalled development sites, financing gaps, missing anchor tenants. From midtown corridors to downtown's still unfinished 2 World Trade Center, success sits next door to standstill. The former Roosevelt Hotel, the Chrysler Building, parts of the South Street Seaport, iconic addresses that should hum, instead hold their breath. Retail tells a similar riddle. High-level metrics tout improving availability, yet Madison Avenue and Fifth Avenue still carry stretches of empty storefronts. Neighborhood corridors mirror the contradiction. From the sidewalk, recovery isn't always visible. Back to the causal chain. What's driving New York to buck national housing slowdowns and steady its commercial footing after years of volatility? 2 forces need the dough: scarcity and selectivity. Scarcity shows up in the months of supply: 0.64 months in Irondequoit, 0.82 in Tonawanda Town, 0.97 in North Tonawanda, Scarcity shows up in above-list closings, 80 to 6.1% in Irondequoit, 72.7% in Cheektowaga, 75.6% in Rochester, and 72.7% in White Plains. Even where days on market stretch, 29.36 in Deer Park, 29.19 in West Babylon, the sale-to-list ratios still hover above 102%, and roughly 69.8% of sales close above asking. That implies bidding remains fierce even when buyers take a few extra days to commit. Selectivity lives in the commercial rebound. Class A towers with modern amenities attract the tenants. Older office buildings, especially those requiring capital improvements, face headwinds. Industrial and last-mile logistics remain firm because delivery habits persist. Multifamily demand improves because housing shortages and rental absorption continue. Investors respond where the fundamentals line up. And prices rising for 5 consecutive months through the fall of 25 indicate more than a fluke. They indicate belief capitalized. Who feels this most? First-time buyers in upstate cities who bring a pre-approval to Irondequoit on a Thursday and watch the house disappear by Monday. Sellers in West Seneca who see 12.99 days on market and plan a back-to-back closing. Landlords in White Plains who price at 105.5% of the list by averaging the last quarter's comps. Developers in Brooklyn and Long Island City who carve out a pet spa next to a bike room because 40% growth in dog ownership since 20 must live somewhere. Operators holding midtown office towers with fresh air intake and wellness floors that fill up. Owners of aging stock who need capital to keep up. Retailers on Madison Avenue who face empty neighbors and wonder when foot traffic flows back. Signals suggest the pet-focused amenity race is not a fad, it's a response to structural demand. That 2025 survey finding, more than half of New Yorkers spending more on their dog's health and grooming than their own, isn't a cute detail. It's a budget item. It shows up in building pro formas and marketing decks as dog runs, grooming rooms, concierge services, daycare with agility equipment, and yes, puppy facials. The decision path that moved a single poodle mix from a noisy hub to a high-floor waterfront echoes in hundreds of other quiet decisions. Viewed together, they move the market. The interplay between commercial and residential is where the story tightens. Office-to-residential conversions accelerated because demand exists, and because some buildings must evolve or slip. When a Class A office fills in, it supports ground-floor retail, keeps sublease space falling, and pushes rents marginally higher. When older buildings stall, that emptiness reverberates. Fewer commuters, weaker street-level retail, more visible gaps in the city's urban fabric. The city's overall return-to-office strength helps, but development costs, political and environmental constraints, and contentious waterfront policies compress margins and slow timelines. The margin for error is thin. Setbacks are loud. Zoom back to the statewide buy and sell markets. The numbers for January through October 2025 read like a heat map, with very few cool zones. In Monroe County's orbit, Irondequoit at $8.49 days and Brighton at $11.05. In Erie and Niagara County's orbit, Tonawanda Town at 1127, Cheektowaga at 1122, North Tonawanda at 1123, West Seneca at 1299, Buffalo at 17.07. In Westchester, White Plains at 21.6 and New Rochelle at 23.89. On Long Island, Holbrook at 24.2, Comac at 23.52, Centereach at 25.94, Smithtown at 23.84, Deer Park at 29.19, in the Capital Region and Mohawk Valley, Albany at 18.44, and Schenectady at 18.46. Central New York's Syracuse at 25.75, the sale-to-list ratios orbit from 101.1% in Albany to 119.9% in Irondequoit. The share of homes sold above list spans from 50.6% in Albany to 86.1% in Irondequoit. The off-market within 2 weeks measure ranges from 8.3% in Huntington Station to 79.9% in Irondequoit. Stat by stat, the market shouts the same thing. Scarcity breeds competition, and competition supports price. It's tempting to treat months of supply as fate. It isn't. It's a snapshot. In White Plains, 1.33 months can still deliver 72.2% of homes above list. In Buffalo, 2.41 months can still deliver a 104.6% sale-to-list ratio. In Syracuse, 1.99 months and 25.75 days on market can still deliver 58.8% above-list closings and 62.4% off-market within 2 weeks. Each place mixes demand, pricing, and speed differently. Buyers feel it in the accelerations. Sellers feel it in the offers. Agents liven the gap between expectation and what the market is actually doing this week. New York's business landscape also shapes who can play. Not everyone can open a real estate agency in the city. It demands a budget, responsibility, and standards. Contracts are detailed. Liability and customer protection are built in. That structure filters outcomes, and it sets a floor for how problems get handled when something goes wrong. It's part of why the amenity race matters. When the framework for doing business is tight, differentiators shift from basics to experience. A pet spa becomes the tiebreaker. A dog run elevates a modest courtyard into an asset that justifies rent. A quiet waterfront walking path turns a fringe block into a destination. The broader commercial story captures that shift toward experience, too. Not all office is created equal. Class A, with modern systems, wins the leasing race. Outdated stock lags. Industrial and last mile stay strong because the math of distance and delivery windows hasn't changed. Multifamily absorbs because people must live somewhere, and conversions follow the heat map of feasibility. Prices rising for 5 consecutive months through the fall of 2025 to something more durable than a head fake. They underscore a market where capital, tenants, and design trends are aligning, even if unevenly. Retail's contradictions soften when you consider who's walking down the street. Return-to-office levels outpace other major USWS communicators. Cities, yet gaps remain in Midtown and on Fifth Avenue. That explains why an amenity like a private dog club can tilt a tenant's decision. If the sidewalk energy is still recalibrating, the building itself must provide reasons to stay. On the residential side, that means a green-tiled dog bath in a rent-stabilized building or a sun-splashed rooftop run. On the commercial side, it means tenant lounges, wellness suites, and flexible spaces that justify leases when the world outside remains in flux. Where do we go from here? Base case, New York carries this split-screen momentum into 2026. In housing, the markets that were most competitive from January through October, especially places like Irondequoit with 0.64 months of supply and Rochester with 1.27, are likely to stay tight unless new inventory meaningfully arrives. Sale-to-list ratios that push to 119.9% in Irondequoit and 115.9% in Rochester don't vanish overnight. Even slower-paced areas like West Babylon, with 29.19 days on market and 69.8% of sales closing above list, still lean seller. On the commercial side, prices have risen for 5 consecutive months through the fall of 25. Vacancies are tightening and Class A leasing is stronger. Return-to-office trends keep New York ahead of other cities. Conversions, hotel strength, and select billion-dollar trades confirm deep pockets still bet on this city. As a result, stabilization looks plausible, and in segments, continuation of modest gains feels likely. 2 watch items deserve attention through mid to late 2026. First, the fault lines in commercial property. Stalled development sites, from midtown corridors to downtown's still unfinished 2 World Trade Center, and iconic properties in limbo like the former Roosevelt Hotel and the Chrysler Building, are not just symbols. They are balance sheets. If older office buildings requiring capital improvements can't attract investment or tenants, they could drag on a fragile recovery. Retail emptiness along Madison and Fifth Avenues is another real-time barometer. Watch whether those storefront gaps narrow by the fourth quarter of 2016. If they don't, the disconnect between upbeat metrics and street-level reality intensifies. Second, supply pressure in the hottest for-sale markets. Track months of supply in towns like Irondequoit, Tonawanda Town, and North Tonawanda from the first to the third quarter of 2026. If 0.64 months creeps higher, bidding may cool. If it stays pinned under a month, sale-to-list ratios above 110% could persist, especially when 70 to 86% of sales close above list. Similarly, if places like White Plains or Holbrook with 72.2% and 77.3% above list closings keep that share high while days on market don't fall, it will suggest pricing power remains concentrated even when speed isn't blistering. There's upside risk, too. If institutional capital keeps re-entering and double-digit gains in sales volume persist year over year, 5 months of price increases could turn into a longer streak. If office-to-residential conversions accelerate further, they could relieve pressure on tight residential markets and stabilize blocks where office struggles loom largest. If pet-centric amenities continue to tip leasing decisions, buildings that invest smartly may see absorption and renewal rates rise, softening the impact of uneven foot traffic at the street. But the real takeaway is simpler. New York is rebuilding momentum, one 8-day listing cycle at a time, one 5-month price streak at a time, one dog run, one green-tiled bath, one tenant renewal at a time. The picture is not smooth. It's uneven and fragile. The ingredients are not consistent. They're lopsided and local. Yet across January through October 2027-5, the numbers say the same thing. Scarcity plus selectivity creates competition, and competition creates price. If you want more clear-eyed, data-anchored looks at how New York's markets actually move, stay with us.